Morning, ladies and gentlemen. I hope you're feeling great and energized to kickstart the final day of London Summit 2022. My name is Elisa and I'm honored to share this day with you. I'm pleased to welcome you to the first panel discussion of the day here at the center stage, Prime Time, Liquidity between Retail and Institutional Trading. To help us navigate these choppy waters of liquidity pools, please welcome our moderator, Hormoz, who will introduce his panel.
Thank you. Hi, everyone. My name is Hormoz. I work for ADSS in Abu Dhabi. We're a broker, but I'm a moderator. I'm neutral today, and I'm trying to get these guys going with some interesting questions. I'll let you guys introduce yourselves very briefly, 20 seconds each, what you do and your company. Andy.
Hi, I'm Andy Biggs. I'm the Group Head of Risk and Trading at Finalto. And Finalto, hopefully you'll seen the stands and all of the advertising the last couple of days. So we're a B2B and B2C broker.
Hello, I'm Alexei. I'm co-founder of Tradefeedr. We're a market infrastructure company. Effectively, we collect the data and do analysis for big banks and all market participants.
Hi, Michael Cairns. I'm CEO of Advanced Markets UK and Chief Risk Officer for the group. Advanced Markets is a global institutional broker in multiple assets.
Hi, I'm Gavin White. I'm the CEO of Invest Global. We're a multi-asset prime brokerage. I'll pass it on to Sam. Cheers.
Hi, Sam Horowitz. I'm head of FX distribution and liquidity management at CMC Markets Connect, which is the institutional brand of CMC Markets. So we are essentially a non-bank liquidity provider, and our parent company, obviously CMC, is well known here as a large multi-asset FX and CFD broker.
Hi, my name's James Dewdney. I cover institutional sales for Saxo Bank in London. I'm primarily concerned with the distribution of liquidity and markets access via fixed API.
Great, thank you. So I'm going to delve into the first question, which is about what the liquidity and the volatility situation's been. What's the events so far this year, 2022? If I can start with you guys, Andy and Alexei, about the liquidity scene in 2022 so far.
So I think in 2022, FX vol is back. So it's been great to see that compared to the volatility environment in 2021, particularly for FX. So I think when it comes to what's been going on, really it's been about central bank policy, the different speeds of central bank policy. And we've seen, because we've had these different speeds, some pretty powerful dollar strength. So euro going from 113, 114 beginning of the year to below parity, has been, I think, for our business, very, very helpful. I think we've seen liquidity generally get slightly worse throughout the year. So when you look at like BOJ interventions or the Truss government, we saw end of Q3, end of Q4. When we look at all of the primary markets, it's been more challenging to provide liquidity. I think on the kind of prime B2B and B2C space, they've been insulated somewhat. So top book spreads have still stayed relatively the same. I think trying to get away large size has become more difficult. But that's to an extent got slightly better in Q4. So I think it's with the central bank policy, different speeds, it's going to be interesting, I think, for the rest of the year and next year. We don't foresee volatility reducing anytime soon. So we're looking forward to 23.
Yeah, Alexei, you guys have a unique position in the market to see that as well, right?
Yeah, sure. So obviously one thing is clear. Volatility is up, liquidity is down. This is a normal trend. Everybody knows about it because balance sheets are kind of not infinite. If I was told, in the beginning of this year, though, that we will have this kind of aggressive hiking cycle and big changes in the market, and markets are still functioning, well, apart from a few examples like UK LDI kind of mini crisis, most markets are still functioning reasonably in at least an orderly fashion. That's probably a testament to market structure still. So like it's still surprisingly resilient to me. Of course, liquidity is considerably down in many asset classes. In Treasury specifically, even Treasury kind of officials admit that Treasury market could have been more easier to interact with. But that's probably related to the impact of interest rates. FX is interesting because of big moves, and those big moves make it clear that although visible volatility and visible liquidity especially is still very like you can think about small spreads and you can think there is a lot of liquidity seemingly in the market, but ultimately you do big size, things start moving, and that's what we see as well. The market impact is hugely affected in like everywhere, like almost like there's a perception that it's probably a well-known perception that cable is trading as an emerging market currency these days because and that's like a market anecdote, but that's what it is.
Yeah, Michael and Gavin, what's your thoughts on this year to date?
Yeah, definitely great to see volatility back. It's a huge driver of volume in our business. I think the primary story of the year has been a strong dollar, and it has driven all markets. So a war in Ukraine, dollar's a safe haven. U.S. inflation at 40-year high, the Fed hiking, definitely driving that dollar again. And then some of the side moves, sterling, for example, with sterling dropping under 107, which was unthinkable, 6 months ago. We have a little bit of chaos in the UK political scene that added to uncertainty and volatility. And then again, we were coming out of a post-COVID lockdown sort of world when, everyone looked like U.S. government pumped money into the economy, flooded the economy, printed money, leading to some of this inflationary issues that they're having now. So I think, all combined, I think it's definitely, I hate to say it, but, our industry does benefit from uncertainty, other people's misery sometimes, some people would say. So it has been good for us.
Thanks, Mike. I agree with Alexei actually about being surprised about the resilience of the liquidity that we're seeing over some of the market events that we've seen this year. I think the markets in various different asset classes, even some of the sort of structured OTC markets, have performed quite well and under the circumstances. But I think it's actually hiding something that's potentially more precarious for us. One of the things, we've got quite a strong association into the Japanese retail market. That Japanese retail market does give indications quite often ahead of other markets about what sort of trends that are happening. We're seeing a lot from our broker clients in Japan, a lot of pressure for them to tighten their spreads to their clients. They're all going through a spread war at the moment and have been for a while. And that's a bit of a risk for the market if that does continue. At the same time, we're seeing a lot of, and it's happening slowly, so it's almost unnoticeable, but a lot of sort of reluctance from the traditional large tier one investment banks to continue to price and be OTC liquidity providers like they have been for the last 20 or 30 years. As we've seen, there's withdrawal from providing prime services from a lot of those tier one banks over the last 5 years. And we've still got situations where, Credit Suisse very recently looked like it might have needed to be bailed out by public money. Regulatory reforms in the investment banking world are not going to ease for any time soon.
You guys are Japanese owned, right? So you get that Japanese carry trade, hopefully, the rest of the next couple of years.
But now we've got interest rates back at home.
Yeah. Okay.
There's a little bit of that. And there's also, because the interest rates, the spreads are tightening, the brokers there are looking for ways, different instruments that aren't about them, sort of capturing a spread. It's about a structured product that might be a different type of revenue stream involved, a little bit more sophisticated products than just the plain basic products. And that's the sort of thing we're seeing. But like I said, the withdrawal and the slow but steady withdrawal of the tier one banks out of liquidity provision, I think, is a risk for us.
Sam?
I think to the original question, what seems abundantly clear to me is that one thing hasn't changed over the nearly 30 years I've been doing this. Markets don't like surprises. The two big risk events that we just talked about, the yen intervention and the terrible situation in cable. The difference between those two, and I hope Alexei would say it probably bears out in the TCA that you've seen. The market knew the yen intervention was coming. It was a question of when, not if, and therefore most firms, and I certainly class CMC in that bracket, we prepared for that months ago. We had all of our config ready. I'd briefed people who'd not seen dollar yen intervention before, but roughly what it would look like, and so we had a plan. We didn't know when it was coming, but we had a plan and we stuck to it. And so the impact for us internally was relatively minor. The complete debacle that was the interim 2-week Tory government's handling of the sterling crisis was terrible. And it looks, as far as I can see on the street, there was a far greater amount of blood there based on people just had to, it was entirely reactive what was going on in the market. And every time I've seen these situations in the past in emerging market currencies or even in G7, it's been the ones that people didn't see coming that have caused the most market dislocation, the most market carnage. Most of the time, FX, I think, has been quite robust over the last few years and relatively, kept relatively well with the start of the pandemic and with all sorts of other market dislocations. But once every couple of years, you get something that everybody didn't see coming, and that's always when you get the big impact.
James, and then I'm going to go back to Alexei on the volatility stuff.
Yeah, no, I mean, nothing particular to add, but I mean, I think Andy's point, FX is back, hooray. But we have an inverted relationship with global turmoil, which is a peculiar thing for all of us involved in markets and foreign exchange. But I think for me, what I think probably is really interesting is to see the unenviable situation central bankers find themselves in, trying to manage inflation without cooling off demand too much. And we see now the likelihood of recession in Europe and the UK is now extremely high. And we see inflation, global inflation is double what it was in 2021 and 2022, but we've got half the growth. So central bank policy is going to be in the spotlight. It's going to be really fascinating to see how it all plays out. But from our perspective as foreign exchange brokers, I'm glad to see the volatility back after a decade hiatus post the GFC.
Yeah, Alexei, anything to add on the volatility?
Yeah, first of all, I'm glad to see all my kind of broker colleagues being very happy about volatility. That's fantastic. From my perspective, the only thing I want to add is that it's actually quite interesting because when you say market breakdown, you basically see volatility and liquidity are 1 for 1. Like double volatility, double the spread. That's what we see in the data. It's like we literally see it tick by tick. Volatility increases, liquidity increases. Market breakdown is that volatility increases and the spreads go not twice, but 5 times. This is a market breakdown in our definition. We didn't see that this year. We saw that a bit in COVID sellout, especially in currencies like Scandis, Nokia, Stocky, because it was related to oil debacle at the time. But we didn't see it this year. We actually see regular market, volatility double, liquidity double, like spreads are double, volatility triple sometimes. Spreads
you think we're going to see that, where the breakdown of the markets at some stage with volatility?
We may. I'm not. I don't have any crystal ball here, but we may. I doubt it's going to happen in FX though.
Yeah. Anyone else? Anything to add on this before I jump on to the next question?
I think one minor point worth making is when people start to look at their market data, and particularly people have prime setups and aggregated liquidity, the deceptive thing is often that you don't just need to consider the top of book spread as your headline number. Because what will normally happen in an aggregated environment is under moderate to medium vol regimes, that often tightens counterintuitively because you're folding and everybody's carrying less inventory at the tier 1 banks and market makers, so they're likely to skew out of that. So you'll see everybody's bid or offer skewed and you get a compressed top of book. It's when you try to clear larger inventory that you really find out where true liquidity is. So true liquidity isn't what's your price in 100,000 or 1 million at the top of the book.
Where is the true liquidity for you guys?
In terms of where
that's my question number 5.
I think that's coming up later.
Yeah, so I'm going to actually jump on to the next question, which is about CFDs. I wanted to just define a good CFD kind of CFD liquidity provider. How do you define a good CFD liquidity provider? And I have a separate question for you, Gavin, on that. I'll start with Andy on that.
So I think it's quite a difficult question because it depends what you're looking for. I guess all clients have got different touch points on what they view as a good CFD liquidity provider. I think CFDs generally, if we're talking about CFDs on indices, are non-fungible, so you have to have pretty much all your flow going to one provider, and it's very, very important that uptime is there. So if you have providers that have the uptime, have the depth of liquidity as well, then that's probably going to be pretty good. And you see challenges across providers of different fair values and.
Sorry, you mentioned you have to choose one good provider. Is that right?
I think your best bet is to choose one good provider and have most of the flow going to that one good provider. I would never say only ever have one provider. I think it's important that people have backups just in case. But I think it's difficult to aggregate, let's say, CFD providers if they've got different fair values. So, I think our view generally for our clients is to try and put as much flow through one provider as possible, and to make sure they have 100% uptime. I think anything less is effectively unacceptable. And to make sure they've got the depth of liquidity to handle anything that happens, especially, we've seen with the focus on news events now, some big moves on CPI or NFP. So it's really, really important that your provider is stable through those.
Yeah. Alexei, do you guys do any CFD work?
We talk to people, yeah, we do a bit, but we're supposed to be neutral. So the only thing I would say is that, yes, it's look for the implementation of it, because obviously in CFDs the devil is in the details, and especially the roll costs and all this kind of stuff are more important.
Yeah, I would just add as well, unlike the FX markets where we have PBs and aggregated liquidity, we can take multiple LPs and multiple streams of liquidity from all over. On the CFD market, it's basically, if you go with one broker or two brokers, you post margin. There's the movement of margin and all that to take into account with what you're doing. Is it efficient? And again, I think if you're looking for a good provider, coverage around the clock, depth of liquidity, and then sometimes, it's not a known quantity either. What kind of model does that provider operate? Is it straight to the market? Is it on exchange? Is it not? Is it, market making themselves? So sometimes, like in a liquidity event, one is better than the other, and I'm not necessarily saying one is worse than the other. I'm just saying in certain liquidity events, those who post straight to the futures can have an advantage, and other ones, those who hold the risk themselves and weather the storm, can do better. But there's a lot to think about.
Yeah,
but again, it's one or two providers is all you go with.
Gavin, which model do you guys operate?
Which model? We operate a model of transparency with our CFDs. So with our single stock CFDs, we offer a direct market access. The clients see their orders, see their trades hit the market. They're all timestamped. They're all subject to the exchange rules. So they're completely completely transparent, and it feels and looks and acts exactly like they're trading cash equities. With our structured CFDs, we ensure that all of our structured products are tied to an underlying exchange market, so that it's not us that is determining the price, and that they're tied to the underlying exchange market in a very transparent and understandable way for our clients to see that it's not us moving our market according to our warehousing or our inventory, nor according to the client's price. It's being totally determined by a market that is independent to us. So our cash products and CFDs are all tied transparently, mathematically to the futures price. I think it would be a good thing if the industry came together and agreed on something like that, because the fact that different providers are, for different reasons, explaining their pricing and cash indices or whatever being different, their explanations are things like, we take the underlying constituents of the S&P 500 and every tick of every... Okay. That's not necessarily true. So if they're not being transparent, then there's a reason why. I think a good CFD broker is one that is transparent and can explain everything about their pricing.
Makes sense. Sam?
Oh, I think to Andy's point earlier, I think he had it spot on. What makes a good CFD provider is completely dependent on what it is you need out of that trading relationship. What it is you're doing with your trading. Is this flow management? Is this entirely prop? What sort of size you're trading? So I think the only thing you can really do to arrive at the right answer is ask the difficult questions and recognize that, in all of these instruments, but particularly in CFDs, what you're making as much as anything is a technology bet on your provider. Can they handle what it is you're trying to do? Is it a fit for their business? Are they reliable enough? Do they have a mature tech stack? Do they have a good track record of coping when it's a bit more difficult? They have good exchange connectivity, for example. And those answers are going to be different for everybody. But that's fundamentally, it boils down to do your homework, I think.
James, keep it close to the...
Oh, sorry, Hormoz.
No, just because of the...
Gavin mentioned transparency. I would say that's crucial. We're also a single stock DMA provider. It's complicated though, because I'm a little bit agnostic, because we have costs of doing the business when we go and buy the physical stock, which can mean that there's challenges in being completely flexible with commercials. Because there's no internalization yield, and we have to go and do that business, and then the custodian has to be paid, et cetera, et cetera. So if the clients get good fills, C-type prices, stops are honored, it's all best practice, highly professional in a regulated environment, is it better if the risk goes onto the book or someone's bought the physical? I'm not really sure. I also think it would be good if we could come together in the industry on the CFD thing.
Can I just add something to clarify, because you're right about that, about there is benefit to internalisation. I'm not against internalisation. There's benefit to people bringing liquidity to the market, and internalisers do bring that, and LPs do bring that. But as long as the price is being determined by someone else, there's no problem internalising. But if the price is being adjusted, is being shown differently to different people, those sorts of things, it's not good for our industry. And I know you're on the same page with that, yeah.
Yeah, so you guys don't show different price to different people. Yeah, okay. So before I move on from the CFD question, actually, Gavin, I wanted to ask you about the single stock CFD trading boom. There was a massive boom. Is that continuing, the single stock?
Not necessarily, to be honest. There was a boom. Look, I have to be really honest about it. We've got a lot of broker clients that are taking single stocks from us and have done for the last few years. I was really bullish about it when we first brought it on. Our team has been involved in DMA CFD offering for many, many years and been very successful. And then we saw the Robin Hood boom and all that sort of stuff happen, and we were sort of sitting there rubbing our hands waiting for it to happen. It tended to be a boom in the US. It was a US stock boom, really, and we didn't really see it. And like I said, we've got dozens of clients offering those stocks. It hasn't been as successful as I expected, but it is growing. It is growing, but it's not the boom that we saw in US stocks. That has not happened in the industry that we're seeing.
Yeah, it feels like crypto and neo brokers are maybe capturing that boom a little bit more. Anything to add on that? On the CFDs, Andy?
Just on the CFDs, I think one of the points we missed is the execution on it. I'm sure, because it's a liquidity panel, we'll talk about no last look at some point. But on the CFDs, I think it's important that your provider can offer effectively no last look or zero hold time. I think if people can do it in FX, they should be able to do it in CFDs.
Yeah, makes sense. So the next question for me was to define a question of, a lot of people use the word recycled liquidity, and I wanted to get a definition of that, but I'm going to start with the non-broker here. All of you guys are brokers, right? So Alexei, how do you define recycled liquidity? What's the definition of that in a sense? And also, I have another question regarding that, yeah.
That's actually interesting, because we did a similar session 3 years ago, and you asked me to define what toxic flow is. Now you're asking me to define what recycled liquidity is, and mine
it's a different question.
Very similar. I think it depends. It very much depends what value you're adding by this recycling. Is Tesco recycling, milk from farmers, or are they actually adding value? Like if I take your price and let's say you're a tier 1 bank and I deliver it to my clients in some other part of the world and different clientele, am I recycling? Or to me, the definition of recycling will be something that can be removed from the stack, and it actually makes the stack at least better, or at least not worse on the surface, and considerably better as a final experience. Well, we all know the examples. I'm not going to go through that, but of course, people kind of push to the same people to the same liquidity, and the problem with that is very difficult to analyze, and that goes to a different question. You have a panel of banks. You trade with a number of banks. Some of them are doing counterparties. I wouldn't call them banks, counterparties, and some of them are recycling. And sometimes you know from the name, sometimes you don't, and sometimes they look like they're recycling liquidity. And that kind of affects all the other banks. You think the more the better, and there was a theory a long time ago is that if you take 50 banks and well, not 50, but 15 banks in your panel, you're better off as opposed to 5. And this theory was disproved quite significantly in the last 5 years through different research by different banks. And we kind of helped, I hope, as well, to kind of demystify this idea that the more the better. So like again, the definition of recycled liquidity is somebody who doesn't add value to your stack, at least mathematically through user experience.
Yeah, I remember one of the bank's research showed that it was the ideal number of liquidity providers is 7. Remember that?
Yeah, I remember that. It's probably correspond to the number of things you can do simultaneously as a human, which is also 7 apparently. So like
very biblical number, isn't it? 7?
Maybe that's a mythical number, but I won't stick with specific number. Very much depends on who these people are. If I give you,
Isn't it a bit like asking the fox how many locks you should have in the chicken house, though?
So let's ask the recyclers. Sorry, no, well, let's ask the others here. What's your thoughts on recycling? I mean, recycling is quite environmentally friendly. It's a good thing, isn't it? But, yeah.
Not in our market.
I think in this case, probably not, because it uses unnecessary electricity. But it's, look, I can only just agree with what you've said. It's for us something that we add to the stack that doesn't add any value. So for me, one of the worst scenarios is kind of phantom liquidity, where you're displaying where you think you've got a certain amount of liquidity, but as soon as you hit one layer, then suddenly the other layer vanishes, because it's just recycled liquidity. So for us, it's something we are very, very mindful of, and the way we manage our liquidity is such that we should never have that issue. I think it's really important that for anyone you have on your liquidity panel, you understand that they are actually taking risk. Anyone who's just recycling or externalizing the risk immediately will generally damage your pool overall. So for us, yeah, it's one of the things we look at more than anything else.
Michael?
Yeah, I would look on it slightly differently. From our perspective, the true liquidity, and there's true liquidity and recycled liquidity. To me, the true liquidity has an interest. Whoever's making that price has an interest, whether it's a bank, whether it's a market maker, whoever has an interest. To me, the recyclers have no interest. It's a matter of, and the worst examples are those firms who take interbank liquidity at a spread or a skew and then publish it across multiple venues. The problem with the whole concept is that the original price is based on one LP or two LPs risk-based pricing on their inventory. So once that inventory is exhausted, the price does not exist. So what you always find with recycled liquidity is, and the key of finding out is multiple rejections, horrific fill ratios, and ultimately toxic flow which decays in milliseconds once it hits the end user. So.
Yeah, makes sense.
I honestly don't really see it as an issue or a long-term issue, because recycled liquidity gets found out very quickly and then burns itself off. So, I think it's not really a major issue. It's funny to look at, though, in terms of what is real liquidity and what isn't real liquidity. And obviously, you're right. Someone that is there wanting to actually take a trade is real liquidity, is putting their interest in the market. But, recycling of liquidity isn't necessarily that bad if it's going to different parts of the industry. So, for instance, there's one futures price for Dow, but yet there's thousands of futures brokers showing that price. Is that recycling you know what I mean? Like, if you look at it that way, well, is that recycling? No, it's just trying to get the price out to as many people as possible. But it's not quite, well, and if everyone tries to hit it, it's not there anymore. So it's sort of, we've got to keep it in perspective a bit as well.
Yeah, Sam?
I think it's worth making the distinction between recycling of liquidity and recycling of pricing information and price construction, because they're not the same thing. You can... liquidity in its purest form is the ability of the market to absorb the shock waves of risk transfer and dampen those down. If you are a true liquidity provider, you should have low market impact precisely because you're doing that. Now, that doesn't mean that everybody out there who is internalizing flow owns 100% of the kit, owns 100% of their IP, and everything is done in-house. So there's a whole range of people taking some pricing information from somewhere, doing something with it, and using that to generate liquidity for clients. And it's what happens when the clients trade that defines whether you're recycling, for me personally. I mean, in effect, we're effectively a non-bank LP. We have our IP is in the price. Clearly we have trading relationships.
How big do you internalize, though? You must need to internalize very big, though, to allow you to take those big shocks and not.
Yeah, it's not straightforward. But yeah, I mean, these things work better on a larger scale. We internalize 99+% of our flow. Wow. The reason we're able to do that is we've come at it from building a very large retail base first. Building out the institutional piece afterwards is the diametric opposite of what, in my experience, what medium-sized banks do when they build a market-making capability, but with low limits first. They say they'll grow the flow, price it first, internalize it later. It's really hard to get to that stage if you start with that. But if you start with all the stuff's internalized and you've got it's not just the decisions on risk management, but it's what the data science looks like behind it is key.
How do you keep your own liquidity providers and PBs happy if you're internalizing everything?
Well, it's a fair question. If they can still have a piece of a large pot, a little bit of a large block. Well, also, to be honest,
I'm asking the questions here, Gavin. I'm just kidding.
I'm happy to answer it. So,
no, yeah, go for it.
In broad terms, the people we partner with and who we trade with out in the street, it's not the wholesale volumes that they care about. It's the behavior. It's the trading relationship on a global basis. Is the flow well curated? Is it generally benign? When there are problems, can we resolve them? It's not they want 80% of our flow and they want it to be yards and yards. We do internalize a lot, but they also know that number will go up and down over the years. As we grow our institutional business, we'll probably start hedging out a bit more. We just have grown-up relationships and we don't dilute them too much.
James?
Yeah, so I think there's a distinction. When we talk about liquidity and flow, I think there's a distinction because I don't think about toxic flow as liquidity. When I think about recycled liquidity, I imagine a market maker quotes a broker, that broker quotes a broker, that broker quotes a broker, that broker quotes a broker, and an end client trades on it. And the market maker that made that bid offer had no intention that relationship price or that price of whatever, had no intention for it to go right round the houses through the market to probably end up being consumed by a client of an intermediary 5 or 6 steps away. I think the problem with it is, as Andy says, I think the problem with it is that it is long-term, it has a negative implication on the execution. And I think in a real practical sense, and I'd be interested to know, Alexei, if you see this as well, but actually quotes, bids on offers have a life. I don't know what that is, 25 milliseconds, 15 milliseconds, or 10, 5, 3 nanos, whatever it is, but it has a life. By the time it's got all the way over there, it's coming to the end of its life. So a lot of the time it just doesn't work. And what we see, what I see in flows we see from intermediaries, particularly ones they're doing a lot of making and taking with each other and stuff, is I see that the quality of the flow is really, really affected by that, because I think that the execution just becomes so shambolic after a while that it's a lose-lose, basically.
Yeah, that milliseconds brings me to my next question, which is last look related. What's a fair execution in the world of last look and fair execution? You mentioned, for example, in CFDs, you give same price to everyone. In FX, that it doesn't work that way, right? You don't give the same price to everyone in FX.
No, you don't give the same price to everyone because they ask for different things and their flow is different. A hedge fund will have a completely different flow profile to a retail broker, and even the retail brokers amongst themselves are aiming for different things. They might want put a special price out in a particular instrument for a period of time, and things like that we do for them. But yeah, it's
Alexei, fair execution. You're in the business of judging. Part of that. So
I want to say we're not in the business of judging. We're in the business of helping people to judge. These are two different things. And kind of going back to best execution, and best execution is a very broad concept, but specifically holding window and kind of last look. My view here is that pretty much probably company view as well is that it's in a business, it's a bilateral relationship. Bilateral relationship, like everything is possible. So you may even, it may go against, like the general regulations as well, and may actually say, look, if you want your LP to last look you, fine. Just make sure you know what you are doing. If you don't know what you are doing, then you're better off. And a lot of people say, I don't want any rejections, please show me a fair spread. And I don't want any trade-offs. It's always a trade-off. In the market, it's always a trade-off. If I have a bilateral relationship, we agree on a protocol, you probably need, and we had a product back in the day, you need a third party to judge if both counterparties are kind of playing by the rule. And that's important because if we agree that we're trading according to certain rules, we call it protocol, then there should be like arbiter in a way. And arbiter is just basically just doing this arbitration and say, look, they're doing what they told they're doing and things like this. That's important. But apart from that, if you feel your flow is reasonably benign, and at least you allow your LP to last look you, I guess as long as you know what you are doing and you can quantify it, that's probably fine. But make sure you kind of communicate this back to your LP and kind of use a service which allows, it's a bit of a plug here, but use a service which allow to agree on the numbers. That's always been our company policy. Like market participants have to agree on what is the optimal way, and there is more than one optimal way for two different people. That's why they call bilateral relationships.
Michael, yeah, I said fair execution, not best execution, by the way. I changed that.
Yeah, in terms of last look, there are some people take the view that it should never be allowed. There should no delay in the execution. I think it depends sometimes on the type of client you're pricing. If your business model is to, for example, post to multiple ECNs where you don't know the end client, I don't think you can remove the ability to defend yourself, to basically do a price check, credit check, because your price is based, as I said before, on inventory, on risk, on your view in the market, sometimes predictive or whatever. But I don't think you can remove that, ability to, like I said, protect yourself. If it's a one-to-one relationship where you know the client, it's a long-standing relationship, as Gavin said before, with different pricing for different clients. Maybe you can remove the last look there, but there are extremes with every scenario. We've seen it in the past where an LP is constantly top a book, but then we find out it's 100 to 200 millisecond last look. So all they're doing is absorbing information from our book, not not executing any trades, and it leads to multiple rejections on our side from the clients. Especially, we operate a DMA model, so we're very dependent on those LPs.
Makes sense. Anything to add, gents? On
I would say I've got two hats on. I've got, for full disclosure, because I sit on the ACI's FX committee as well. And obviously, this is a pretty thorny subject that's come up time and time again. It came up in Paris last week. If we remember what last look was intended for, why it even exists in the first place, in the early 2000s, for anybody unlucky enough to be as old as me, the first couple of banks to offer any kind of electronic offering, it was a nascent technology, buggy as hell, latent, and just right for being picked off by clients. And this was absolutely rife, and it was clearly they knew they needed to grow market share in this new business, but it was very hard yards for those two banks that were at the forefront of this, and they got picked up every day in industrial quantities, and it was thousands of pounds of P&L bleed. And then I think it was the summer of 2004, both of them within a week of each other said, right, enough, all the predatory clients were gone. Last look at that stage was simply a check on the fidelity of the pricing and were there any serious issues with transmission that caused it to be massively off market, and in essence not very different from the same workflows at voice level. Fast forward 15 years and people have been making under the hood tweaks to that left, right and centre, cherry picking the flow, asymmetrically rejecting, all of those things. And the ACI's view on this is pretty clear, and the GFXC's view on this is pretty clear. Do unto others as you would do to have done to yourself. If it's simply a mechanistic check, symmetrically applied, to make sure there's no serious issues of price transmission, I don't think anybody really has a massive issue with it. And we symmetrically reject, so then if the price has gone in the client's favour, we might still reject it, even when it would have been better for us to quietly accept that trade. I don't think people have a massive issue with that, and some people would rather have that than no rejections, and we solve for it with spread if they're trying to hold to commercials to their clients downstream. It's all this other smoke and mirrors that I think people have a massive issue with, and I think rightly so.
James,
Yeah, I think that the way you could turn this on its head slightly is to imagine, would it be acceptable for the market maker or liquidity provider for their trade to be P&L negative from inception? And if you think that's acceptable, think about the profound implication it's going to have on spreads in the market and liquidity in general. So Alexei said that it's a trade-off. I think it is a trade-off, and I think it's entirely reasonable that market makers are able to do a quick price check against the prevailing bids and offers in the market to make sure that the deal that they're about to fill is a good price and it's in line with the price at the time of the trade.
Andy?
I think one of the things we've seen is with an increase in the tick frequency of primary markets, those last look checks, if they do happen, should be very, very, very short. So, any response over a single-digit millisecond is isn't that great.
Okay, makes sense. I'm going to ask the audience some questions later on. But before I do that, I have one more question about the non-bank specialists in liquidity, in market making. Are they still going strong? What do you guys see, the non-banks? Are they kind of, is it happening more than before? Or is it same players, same thing? Or what do you see, Alexei, on the non-banks?
Well, it depends how you define before. More than before is like more than 10 years ago or more than
5
last
minutes
year.
ago.
Yeah.
Oh,
yeah.
yeah.
It's
Few years ago.
definitely going strong. I think one of the big themes in the market is that people are trying to use their data more effectively and effectively manage clients in a more quantitative way. I.e., like companies like ours, basically, they provide to banks at client request kind of ability to manage flow and manage liquidity more efficiently. So instead of talking to banks and to like typically a bank talks to you and say, who are you? Okay, like what sort of, okay, and you say, promise my flow is fantastic, you will not lose any money, and then they run it for 2 weeks or 3 weeks, and then they say, oh, actually it doesn't look this way, and then they start fine-tuning, and then like the whole process is hugely inefficient, but they're not set up to do more efficient process. Like non-banks obviously are all data-driven. They're much more designed to adjust to the current environment. Not all of them. I wouldn't want to say, like, just set up a non-bank and you're going to be making millions or billions. It's not true, but some non-banks are specifically designed for the current environment, which is much more transparent. I think COVID helped with this because actually, people are much more keen now to rely on data and not do any coffee breaks or dinners or kind of all this old stuff that we used to have. You go for dinner, you do some business. So that actually helps, and that we see in the data as well. People are doing much more efficient job. They have very small sales forces, and they effectively say, okay, give us some more data. We give you an optimal spread. Not happy, show us some more evidence that
Sam, how about
a better spread.
you guys? Are you seeing more usage of non-banks, in your opinion, than 4 or 5 years ago?
You only have to look at the Euromoney rankings, the FX Week rankings, any of these studies. So where do XTX sit at? Sit 1, 2, 3, 4, somewhere up the top all the time. There are others behind them. And obviously,
are there going to be more? That's the question. Is it going to? Is this the trend?
Yes, I think there's a couple of reasons why it will. One is that tier 2 banks are dialing down their inventory all the time. So the number of real, true internalizers and liquidity providers in the way that I defined it earlier is gradually eroding. Secondly, there's actually a talent drain as well. So there are people popping up all over the place in seats in other firms that would have not existed 10 years ago or been firmly in the match principal agency mode 10 years ago. People who've run inventory at larger shops are going to those firms, and you look at what the guy's doing is solid and all sorts of places like that, and you think, okay, you've got 9/10 of what it looks like to be a bank. You haven't got the big balance sheet, so the liquidity provision is slightly it's very dependent on the existence still of the prime broker world, because without that, obviously, the stuff kind of falls apart quite quickly. But in every other respect, and it's the same when I'm sitting at CMC, I walked in on day one having spent most of my life at bank market making. It looks like a bank. We have a very good quant and data science team. The data we have access to is phenomenal. The techniques would not look out of place elsewhere. The people would not look out of place elsewhere. And I don't think for 1 second we're the only firm with that kind of a profile now of who we're hiring and what we're doing. So absolutely feel the time is right for this.
James?
Sure, thanks. This is a good question. It's interesting, right? Because I think what this comes down to is how sophisticated the liquidity users are themselves. What I noticed, I used to work in Citibank in their PB business, and I noticed that the real major liquidity users that we served weren't trading with non-banks because they've carried out reasonably complex transaction cost analysis, and they've looked at market impact, and they've decided, actually, do you know what? I don't need to have a stack of 15 names with all these speed merchants on the east coast of America and stuff. I don't need that. I need 4 or 5 names that carry substantial inventory risk overnight. And that really is liquidity provision. And they've used their quantitative, mathematical, statistical expertise to really assess what it means what market impact means when what you're really dealing with is potentially someone who's agency broking on steroids.
Yeah, Gavin, anything to add on that?
Yeah, I think this is a great question, and I think we're right at the start of 3 decades of non-bank dominance. I think it's a repeat of history. I think this is exactly what happened with the introduction of the Glass-Steagall Act in 1932. That wasn't touched until 1960 in US in legislature. Commercial banks had to stay out of investment banking for that period. That wasn't repealed until 1999, allowed the banks to come back into the trough and cause the global financial crisis. We're just going round in a circle, and we believe we're at the beginning of that same situation where it's the banks being forced out of these businesses. In Glass-Steagall Act era, it was a definite. You could not do both. Now they're trying to force the commercial banks out of investment banking in monetary ways, in commercial ways. If you want to do $1 billion FXPB facility with this broker, you need to hold XYZ of Tier 1 capital on your balance sheet to do that. That's forcing them out of prime broking, which is also forcing them out of liquidity provision.
It could change as well with the Fed rates and all that, right? Anything to add, gents, before I go to the audience?
I'll just say the one thing, for me, I've been disappointed, really, with non-banks. I thought they'd be a lot quicker or a lot better, a lot quicker than they actually are. You know, they were the incumbent, I would say, non-banks who are still doing a great job. But any of the challenger ones aren't where I thought they would be at this stage.
That's big. Andy being disappointed with non-banks, that's a big statement.
Yeah. Just one quick thing to add. From what we see from our perspective on non-bank pricing, I think the quality has improved of the the participants in the market, and another thing, I think they all have a genuine interest, so their skew is pretty substantial. So taking the non-bank as a sole liquidity provider, maybe not so good. Adding them to a stack of aggregated liquidity, I think you get massive spread compression. So it helps all around, especially on our business.
Okay, thank you. So, questions from the audience for these guys. I know there is a question. There's a few people I know. Can we get the microphone here, please?
Thank you. That was very interesting, guys. Hormoz, you asked a very interesting question about what makes a good liquidity provider. From my perspective, I'd like to ask you in the panel, what role does market data, the licensing provision, because going from liquidity provider to liquidity provider, you each have different offerings, and some are much wider and some are much wider and deeper. So I'd like to know how you're addressing the market data angles, because that's your primary function in terms of how things roll. Without the market data, we have just some pretty screens and charts.
Andy, do you want to take that one?
So from an FX perspective, I guess the market data that we would provide, or any of us would probably provide, is going to be based on offering the client sustainable liquidity. So in terms of what would be provided, I think it's something that almost comes out of the bag with FX. I think when you get into single stocks and the CFDs, it becomes a lot more complicated, with a lot more regulation around it, and exchanges being really quite awkward. So I think for the FX piece, it's a little bit out of the box, more complicated on the CFD side.
Yeah, I think it's a very good point, actually. So with market data, what you can do even today, and I completely agree, and FX is actually quite simple, because every market maker kind of manufactures their own kind of stack of liquidity in a way. It's kind of hugely correlated to the global level of, euro dollar or whatever cable or whatever price, but they manufacture their own stack. And this stack can be in 1, 3, 5 or whatever. So this stack is visible to you in real time. You can track this stack. You can see who is providing you liquidity consistently, not just the winning liquidity. You can see also who is there for you in difficult environments. And this is an argument about balance sheet. A lot of banks, they come to you and they say, oh, we have a big balance sheet. Maybe all these non-market makers, there's counter argument as well. The non-market makers is that they say, oh, great, they're there for you. They show you a small spread, but actually then things become tough. They're not going to be around. And this at least allows you to have this volatility to spread in relationship. You can study it yourself. You have your market data. It's coming to you via fixed protocol. All you have to do is to ask a bank to collect it and get an access to it. And it actually can be summarized pretty easily who is providing you good liquidity, even independently on of your trading, because that's the most important thing in my view.
Anything to add? That's it. Any other questions? Raise your hands. Last one.
Hi, it was mentioned earlier that you think it's bad practice to offer different prices to different clients. I just wonder if you all agree on that, and why you think that's the case.
Yeah, I think you explained that the dynamics of different clients have different needs, right? That's, mainly the thing, and the agreement.
I mean, you should always have the transparency that you are, at a base level quoting the same price to everyone. That's a fair fact, that the base level should be the same for everyone. But different clients require different types of liquidity, and it really does require knowing your client. It's a long process of working with them to work out, do they not want a certain liquidity provider to be in their stream? Do they want their liquidity to be provided in levels that are of a certain size or not? Or do they just care about the top of book spread as their most important thing? So the key for all of us really in the prime space is to find what our clients want in that liquidity and then try and construct it for them. But it's not a case of discriminating against clients or using any information that you might have about that client to provide them a different price. As soon as you get into that realm, then you are doing something that is not fair and should not be accepted in the industry. In terms of these types of things, we do have a global code of conduct. It is really, apart from regulation trying to address some of these behaviours, it is the only way we have to address these behaviours. So my message is to encourage everyone to get behind that central body and that global code of conduct. Our company is a signatory to it. It's voluntary. It doesn't have teeth. We all understand that, and it's a difficult situation. But nothing's perfect. We've got to take a step forward, and I think that signing up and having that as a central part to our business, a code of conduct that we all agree to, is a step forward.
That's it.
Done my marketing speech for me.
Yeah. Any other questions? Quickly, we're done, I think. Okay. Thank you. Thanks a lot.